This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Dizzying day. Stocks were whipsawed, sinking, recovering over and over and over again as the Dow cuts yesterday's losses in half.
What not to do, how you can protect your savings from the volatility if you are retired or nearing retirement.
Thrill ride. Theme parks deliver for Disney as the Dow component reports a rise in revenue and easily tops earnings estimates. Those stories and more tonight on Nightly Business Report for Tuesday, February 6th.
And good evening, everyone. What a wonderful turnaround on Wall Street if you are long the stock market, but it did not come easy. Volatility reigned everywhere today as shock waves from yesterday's dramatic sell-off rippled through the financial markets. Stocks dropped sharply at the open, and they rallied, only to fall and then soar again. The comeback was the biggest for the Dow and the S&P 500 since 2011, and let's get right to those closing numbers. The Dow Jones Industrial Average rose 567 points to 24,912. And get this, at the open, the index immediately fell 567 points. There's something about 567. Think about that when you play the numbers. The NASDAQ added 148. The S&P 500 was up 46. Investors blamed the volatility on interest rate concerns, computer-driven trading, and obscure volatility funds that use leverage. Bob Pisani now with a look at the day's action from the New York Stock Exchange.
Talk about another roller coaster ride for the stock market. The Dow tumbled about 560 points right after the open, breaching Monday's lows, but reversed course to rally 600 points after wavering between gains and losses throughout the session. By the end of the day, the Dow traveled in a more than 1,000-point range. We haven't seen volatility like that in all of 2017. So the Dow did hit correction territory very early on. So we're down 10% from the recent highs, but held on to gains throughout the close, and it managed to stage its biggest comeback in 7 years. The good news is this is market mayhem driven by technicals. It's not fundamentals. This was not an economic scare. The credit markets are doing fine. Gold's not budged. Corporate America is still healthy. The world's still spinning. Remember, the three major risks to the market are, number one, inflation. Number two, valuation. Market's expensive. And third, politics. Now, in the last 24 hours, nothing's really changed on the inflation front or even on the political front. So what's different? Well, valuation risk is a little lower, and that may account for the rally late in the day. The market's getting a lot cheaper. We've gone from really overbought to really oversold in a little more than a week. Not dirt cheap, but a lot cheaper than it was a week ago. And everybody who said, I'd like to buy 10% below the market, well, it looks like some people did. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And for more on why the market may be behaving this way is Peter Costa, president of trading firm Empire Executions from the NYSE. Always good to have you with us, Peter. Thank you for joining us.
I'm glad to be here.
What was it like down there today, and what does your trader's gut tell you about what's coming next?
Well, several things. Number one, it was crazy, and I've been in some crazy markets, not crazy busy, but crazy in the movements, having the market up 100, then down 75, then up 100 again. The market whipsawed all day long until right after 2 o'clock, and then it started its rise. And you know what? Everything kind of settled in as we were going up. But this is volatility, and this doesn't go away overnight. So what I think what'll end up happening is it will probably be volatile for the next couple of days, maybe into early next week, and things will start to stabilize at a certain level, and the market will go back to looking at more fundamentals, earnings growth, what's going to happen with interest rates, so on and so forth. But right now, for traders down on the trading floor, this is actually a very profitable time because our clients are very active.
Yesterday, Peter, felt to me like machines reacting to triggers that only they could see. In other words, program trading and so forth. Today, maybe a little less so, but how much of what is going on over these past couple of days is really human beings buying and selling?
I think today there was more of the human element as far as traders getting involved because of the volatility and the price points where people could get in and get out. Yesterday, definitely, there was no institutional selling as far as I could see. It was all computer driven, and a lot of that was also the buyers disappeared. Once there were certain price levels that were reached, the buy side or those buy orders canceled. So the market just had that downdraft that nothing really could stop it until at some point something stopped it. More like, maybe some institutional buyers came in at the very low levels trying to pick a bottom. Today was more of a trader's market. There were a lot of, the swings, not so many computer programs, but there were programs going into the close. So it was a mix of both. We want more institutional traders in. We want more institutional interest in. But I think they've stepped aside for a little bit to let this market kind of like play this out and get back whatever they're looking to accomplish, either on the short side or on the long side. They will be back in. It's just right now, I think they stepped away for a little bit.
Understandably so. Peter, thank you. As always, Peter Costa with Empire Executions.
The Treasury Secretary has been watching what's happening on Wall Street and today told Kayla Tausche that the fundamentals of the economy remain strong.
The economy is doing very well. Tax reform is clearly helping earnings a lot. And the markets look like they're functioning normally in terms of liquidity and other things. So
what about the reaction across the world?
Again, markets move in both directions, and they're functioning very well. I'm going to my testimony. People should be focused on the long-term investment. Americans should focus on the stock market. Over the long term has been one of the best investments, and we'll continue to monitor it. Thank you.
And also on Capitol Hill, the head of the Securities and Exchange Commission told lawmakers that the markets are functioning well and that his agency continues to monitor the volatility.
As I sit here today, there's nothing that came out of this that concerns me from a functioning standpoint. But days like yesterday, our job is to look at them.
And Clayton declined to comment on why stocks fell so sharply yesterday.
Throughout the day, market experts were sharing their thoughts on what's been happening in the stock market and offering opinions on how it all might play out.
A moment of volatility like this and a pullback in price, quite frankly, it's to be expected. And I think as a group, we need to take a deep breath and realize we're going to be okay.
I do think that these type of events usually take 2 to 3 weeks to work through the system. And so with that, I think volatility remains elevated for at least 2 to 3 weeks.
Markets remain thin and they remain volatile. And quite frankly, doing this 50 years, that's just what you need for a bottoming process to succeed.
That's what some of the pros have to say. But what about you, the individual investor? Well, we took our cameras to find out.
I'm kind of just keeping moving in all of the frenzy and hoping that my portfolio will hold out, And I have another 20 plus years I'm hoping to be in the market, so I'm hoping that's on my side as well.
Stock market will return, maybe not right away, but it will return. That was a bubble, of course. I mean, everybody understands that. It was riding up like a crazy, like a rocket.
My thoughts are a little stressed, but I remain calm because I've been through a number of market cycles, and I realize time is on our side, and as long as you hold on, it will come back.
I'm going to wait it out for a while. I've been through this before. I was through it in 1987, and then again in 2000, 6 or 8, so it always comes back.
No, his wife is hitting the sell button saying, get it out and get it into cash.
I think the most important thing is to think for the long term. Most people see this and they get kind of scared and they don't realize that they probably have another 5, 10, 20 years in the market. And over time, there's been very few things that have done as well as the stock market, as Warren Buffett would probably tell you.
All right, so do those individual investors have it right? Let's bring in a longtime market watcher who says the recent pullback in stocks may actually be a good thing for the market. Joining us is Jeremy Siegel. He's a finance professor at the University of Pennsylvania's Wharton School of Business. Over time, Professor Siegel, the stock market has really performed better than almost any other asset class. Does yesterday change that at all?
No, not the long run. What we really had was the market went up too far, too fast. I was even saying to myself, January is crazy. Momentum players. Now, momentum investors are those that say, hey, I'm going to follow the trend. I don't care about valuation. I'm jumping on the train. And they place their stop orders. Those are sell orders just a few percent below. I said, when the train starts slowing, I'm jumping off. Well, with the interest rates began to go up, Friday was a little bit of a problem. It just multiplied, and they all jumped off yesterday. And that produced the vacuum and the big decline. I mean, now we got much sounder values right now. You know, there's an old saying on Wall Street that goes back decades called up the staircase, down the elevator. And January was our staircase, and early February was the elevator. And this type of behavior is not something new. It's been true of speculative markets for ages.
Did the shakeout yesterday, did all of those momentum players take the elevator and get off, do you think?
I think most of them did, because it wiped out the gains of January at the low. You know, I'm not saying all of them are out. And, you know, even last year, I said this year is not going to be as good, anywhere near as good as 2017, and it's going to be challenged by higher interest rates. We have a very strong economy. I think the Fed is going to raise 4 times. Higher interest rates are a negative factor for stock prices. Now, on the other side, you have great earnings, so it's a battle between the great earnings and the higher interest rates, and that's what I think is we're going to see throughout 2018.
Professor, talk to the individual investor who I can well imagine might be concerned at what he just heard Peter Costa say, and that is that yesterday's spasm of selling was being driven largely by computers. Have the machines got too much power? And what should I, as an individual investor, think of that?
I'm not sure of that, because momentum players, speculators, and they were around in 1929 that kept on driving the market up. And they were around, of course, in 1929, 1999 during the internet bubble. It is a feature of speculative markets. Whether you set it on a machine or a human being, you know, says, I'm selling at this point, really the final result is the same. It's just that in today's world, it's going to happen so much faster. It's going to take place in a matter of minutes, not a matter of hours or days.
All right. Professor Siegel in Philadelphia, congratulations on the Eagles.
Thank you very much.
All right, Jeremy.
We're proud.
Thank you.
And still ahead, the president says he welcomes a shutdown, even as lawmakers say progress is being made on a budget deal.
Disney shares closed higher today, and after the closing bell, the company reported earnings that blew past Wall Street estimates. Disney earned $1.89 a share. That was a full 28 cents better than forecasts. Revenue up nearly 4% from a year ago to $15 billion. Investors like what they heard about strong attendance at theme parks and resorts. Julia Boorstin now with more on the quarter. She spoke to Disney's CEO.
Disney beating expectations thanks largely to the outperformance of its parks and resorts division. The company saying that it saw higher spending and higher attendance at its U.S. parks, both in Orlando and Anaheim, California. Also saying that it had seen higher performance of its cruise line division as well as Disneyland Paris.
It starts with success across the globe, particularly in some of our international, or in one particular international park and resort in Paris that had a number of years when the numbers weren't that good, and they've improved substantially. But we've also had record results for our domestic operations as well, record revenue, record bottom line. So it is basically an across-the-board success story.
Disney CEO Bob Iger also saying he's optimistic about the company benefiting from digital distribution of its media network, such as ESPN. He also announced that ESPN Plus, the new subscription app that's launching sometime this spring, will cost $5 per month. For Nightly Business Report, I'm Julia Boorstin in Burbank, California.
Well, the battered tech sector bounced back after getting walloped yesterday, and it's a sector that investors watch closely since it was the best performing one last year. Josh Lipton is in San Francisco for us tonight.
As volatility returns to the stock market, investors have been selling their winners, and that includes some of the biggest names in technology. And this comes despite a pretty good earnings season for the sector. Profit and revenue growth have both exceeded expectations. But that doesn't mean last year's hottest sector is immune to a broader decline.
We have the advantage of having these companies just reported in
Q4 earnings just last week. And by and large, what those numbers show you is that demand fundamentals remained extremely strong, particularly for somebody like an Amazon. But even if Facebook, even for a Google or an Alphabet, I think if there is any pushback potentially to be had is on the margin, on the fact that all these guys, to continue to grow at that level, they're going to need to continue to invest. And therefore, there is a potential for margin contraction over the next year or two.
Take Apple, for instance. There's been a lot of focus on its iPhone franchise. The company reported record quarterly revenue and earnings per share, but it sold fewer iPhones than expected during the holiday quarter. Then there's Alphabet, where revenue jumped more than 20% in its latest report, but there is worry about the company's higher expenses, specifically the fees that it pays partners for traffic. There are still reasons why tech is an attractive sector to investors, even as they prepare for the possibility of more volatility. One reason is dividends, and some of those can be found in the bluest of blue chip tech stocks. For Nightly Business Report, I'm Josh Lipton, San Francisco.
The rubber met the road at General Motors, and that is where we begin tonight's market focus. The automaker said cost-cutting initiatives and demand for high-margin SUVs and crossovers helped results top estimates. Overall, GM said it saw a lot of bright spots in the quarter.
Very, very pleased with the results in North America. A record there at $2.9 billion and 10% margins in the fourth quarter. Another $500 million quarter of equity income from China, and really important improvement in our GM International markets, another profitable quarter in South America.
GM finished up almost 6% on the day at $41.86. Strong demand for Botox treatments helped Allergan post better than expected profits and sales. Separately, the company said its experimental migraine treatment performed well during a study, and that made investors feel better, sending shares up 2% to $168.33. Tapestry said its Coach and Stuart Weitzman brands saw more customers buy more stuff during the holidays, and that helped overall sales edge past expectations. It didn't say it exactly that way, but that was the point. Earnings also came in ahead of expectations, and the company hiked its guidance for the year, and that helped push Tapestry up more than 9% on the day to $49.02.
The health insurer Centene raised its profit guidance for the year after reporting stronger than expected earnings. The company attributed the solid results to higher enrollment in its affordable health care business and also benefits from the new tax law. Centene finishing up more than 4% on the day to $103.67. After the bell, Chipotle topped analyst profit expectations as the burrito chain said results were helped by fewer promotions and higher menu prices. Same-store sales and revenue also edged higher, and the company said it's making good progress on finding a new CEO. Chipotle shares were volatile in the extended session, but they ended the regular day up more than 1% to $304.33. Out after the bell, Snap reported active user growth that impressed Wall Street analysts. The social networking company also saw sales pick up, larger than expected gains there. Snap shares popped in after hours, but finished the regular day up 21 cents to $14.06.
The president today called for a shutdown of the government if Congress does not pass border security measures.
If we don't change the legislation, if we don't get rid of these loopholes where killers are allowed to come into our country and continue to kill, if we don't change it, let's have a shutdown. We'll do a shutdown, and it's worth it for our country. I'd love to see a shutdown if we don't get this stuff taken care of.
Well, the comments came as lawmakers on Capitol Hill said progress was being made on a spending bill to keep the government up and running past the Friday deadline. Ilan Mui is in our nation's capital tonight. Ilan, where do we stand on these negotiations to keep the government open?
Tyler, it does not look like we're headed for a shutdown. The House is looking to pass tonight a short-term spending bill that would keep the government open through March 23rd. Now, it would keep funding for most agencies at current levels, but it would increase spending for the Defense Department and for community health centers. Now, this is a very different tack, though, than the Senate is looking to take. Over in that chamber, both Republican and Democratic leaders are trying to come to a compromise on a long-term spending bill That would fund the government for 2 years, and it would increase spending both for defense and for non-defense. And that is a point that is very important to Democrats. They call it parity, and they say that would be a win for them. Now, of course, keeping the government open, though, is one of the key responsibilities of lawmakers. This is a long-term spending deal that has eluded them for many months, but both sides say they are very optimistic that they can reach a compromise soon.
You know, one of the things that Wall Street is also very worried about right now is the status of the debt ceiling. What can you tell us there?
So this is something that is on the table to be included potentially as part of that longer-term 2-year spending deal. But lawmakers have not decided whether or not to actually go forward with that strategy yet. The deadline for raising the debt ceiling is around mid-March, according to the Congressional Budget Office. So they have to do this soon. Unclear if it will be part of this larger spending deal or not.
So, Elon, let me understand this. Is immigration tied into the budget deal that you were just talking about? And if it isn't, is the president ready to veto a long-term spending deal?
It remains unclear. Right now, though, what we can tell you is that immigration is a separate issue from this spending deal. Those are going to be on separate tracks here on Capitol Hill.
All right, Elon, thank you very much. Elon Mui on Capitol Hill.
Well, today we learned that the trade deficit has soared to a 9-year high. For 2017, the gap leaped 12% to $566 billion. Last year, the U.S. imported more foreign-made cars, computers, and cell phones. The deficit with China hit a record, and imports from Mexico also hit a new peak.
Coming up, are you retired or nearing it? What you should do and not do in this type of market.
It is time to take a look at some of today's upgrades and downgrades. ExxonMobil was downgraded to underweight from overweight at Barclays. The firm says the stock is richly valued and cites a structural deterioration in its upstream business. Exxon's price target was cut to $84 from $91. The stock fell nearly 2% to $78.35. That same Barclays analyst upgraded rival Chevron to overweight from equal weight. The firm cites improving fundamentals and an attractive valuation. The price target was raised to $135. Shares of Chevron were up 4% to $117.18.
Micron Tech upgraded to overweight from sector weight at KeyBank. The firm says the stock is, quote, too inexpensive to ignore following Micron's upbeat earnings guidance. Price target now 53. The stock climbed 11% today to 43.88. And fellow chipmaker Cirrus Logic downgraded to hold from buy at Needham. The firm cites weak third-quarter results and guidance. The analyst also concerned about weaker smartphone demand, given that Cirrus makes chips for Apple's iPhones. The stock off 3% to 43.40.
Well, the flurry of activity in the markets has many investors taking a closer look at their portfolio. So what should the average investor do to prepare for more volatility? And what about soon-to-be retirees or those who are in retirement? Joining us now to offer her insights on that is Stacey Francis, President and CEO of Francis Financial. Stacey, welcome. Nice to have you here.
Thank you. Great to be here.
So given what we saw yesterday and then today, if you are in retirement, what should you do, or perhaps better said, what should you not do?
Exactly. The latter part is definitely true. What should you not do? And the biggest thing you shouldn't do is you shouldn't panic. And we've seen that individual investors who think they're smarter than the market are actually not. And the individual investor typically underperforms the market by 6% because we tend to sell at the exact worst time, like now, and we tend to buy at the exact worst time, like Bitcoin. Do you remember that one?
Yes, we do.
And really, Stacey, drill home the point. If you are going with an asset allocation plan of 60% stocks and 40% bonds, or 50-50, or whatever it is, if you are out of the stock market for a very small number of days because you got an itchy trigger finger, you miss out on a lot of the returns in stocks, right?
You miss out on a huge amount of those returns. And a case in point is we look at 2008, people who were out of the market that year after, for many of them, they still haven't actually recouped the losses that they saw. Those who stayed in the market, even the worst time when we saw February 2009, really at the bottom, that's when it started back up. You have to be in the market. And the most important thing is that, if anything, yesterday and today was a gift for you. It was a wake-up call. It was a wake-up call after a year where in 2017, we really didn't see much volatility. It's important to make sure that you've weatherproofed your portfolio, because I have to tell you, for 2018, there's going to be more storms around the corner. Definitely a lot more than what we saw last year.
So take a look at your asset allocation, make sure you're comfortable with it. And you've made the point in the past to us that make sure it fits the goals that you have for retirement, correct?
Exactly. Unfortunately, a lot of people think of their portfolio, I feel, the wrong way. The portfolio, it's truly an engine. It's an engine to get you to your goals of that retirement date, of living that that beautiful golden years in Tampa, somewhere warm. Maybe it's Albuquerque. But essentially, that portfolio needs to be your engine. And so, what engine do you need? You need a souped-up engine. You're going to have a lot more stocks because you might be a little bit behind. Otherwise, you could even maybe have a Prius engine if you've been able to save enough that you don't have to take on that risk.
Okay. On that note, thank you, Stacey. We appreciate it. Stacey Francis with Francis Financial.
All right, before we go, let's take another look at today's big turnaround on Wall Street. The Dow rose 567 points to 24,912. That cut yesterday's losses basically in half. The Nasdaq added better than 2%, or 148 points. The S&P 500 up 1 3/4%, or 46 points.
And it's only Tuesday.
And it's only no wonder we're all so tired.
I know. That's it for us tonight. I'm Sue Herrera. Thanks so much for joining us.
I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we'll see you tomorrow.